Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at MakeMyTrip.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we dive in, we have a quick resource to share. If you're looking for a better way to visualize the markets, you should check out VIP Algos. The link is below in the description.
Yeah, that's a super helpful tool.
It really is. It's a TradingView indicator suite that gives you visual buy and sell chart alerts, trend direction tools, support and resistance zones, and areas to plan your take profits and stop losses.
Which is great for just, clearing up chart clutter.
Exactly. But please remember, VIP Algos is an educational tool only. It's not financial advice, it does not guarantee profits, and trading always involves risk. So, do your own research. Also, this is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
All right, so setting the stage for today's analysis, we are looking at a stock that is currently caught in what I'd call a psychological pullback.
Yeah, a pretty classic gap down phase right after a Q4 earnings miss.
Right. And if you just glance at that immediate market reaction, the headlines, you would assume the underlying business is breaking down. But peering underneath that noise reveals, a completely different reality.
A massive one, actually.
Yeah. This company just crossed a monumental threshold. For the first time in their history, they generated $1 billion in revenue. And they facilitated over $10.4 billion in gross bookings.
Which is just staggering scale. I mean, scaling a platform to handle over $10 billion in transaction volume, that requires a level of logistical and technical maturity that very few regional players ever achieve.
Which really forces us to ask the big question today. Is this post-earnings dip a glaring red flag? Is it signaling that the business model is exhausted?
Or is it a prime entry opportunity hidden behind, short-term market volatility?
Exactly. We need to figure out if the headline reaction is right or if the underlying plumbing of the business is telling the real story here. All right, let's move into the wealth building context.
So framing MakeMyTrip properly means understanding it as a multi-year play on the sheer scale of India's underpenetrated travel market.
The macro environment.
Exactly. We are witnessing this historic, basically once-in-a-generation expansion of physical infrastructure across the country. I mean, the government is rapidly constructing new airports, they're expanding vast highway networks, modernizing rail systems.
All of that is aimed at Tier 2 cities, right?
Yes, precisely designed to cater to this massive surge in Tier 2 city travel demand. We are talking about millions of people gaining access to frictionless domestic and international travel for the very first time in their lives.
Okay, but let me test that assumption for a second. Because relying purely on a macro-level infrastructure narrative it's a trap I see investors fall into constantly.
How so?
Well, just because a government spends billions building a new highway or, a new airport, that doesn't magically mean a specific tech company is going to capture all the economic value.
Fair point.
Massive sector growth usually invites massive, brutal competition. And that typically leads to an aggressive race to the bottom on pricing as companies try to buy up market share.
A rising tide absolutely can drown the unprepared, especially in tech. But viewing MakeMyTrip as just another competitor riding the wave kind of misses their structural position.
Okay, what do you mean by that?
Think of them less as a participant in the travel market and more as the underlying operating system for it. They already have the supply-side network entirely locked down.
The hotels, the airlines.
Right. The domestic airlines, the thousands of independent bus operators. Because they command that dominant market share, they're basically the apex predator. Any structural growth in Indian travel feeds directly into their existing ecosystem.
So they own the toll booth.
Exactly. When a new regional airport opens, the flights are immediately booked through their platform. They capture the value of the physical infrastructure without having to spend the capital to build it.
That frames this as a story for a highly specific type of investor, though. We are talking about thesis-driven individuals looking for multi-year compounding.
Yeah, people who are willing to stomach the inevitable volatility of an emerging market.
Right. Because if someone approaches this looking for a quick, risk-free return, they are looking in the wrong place.
Oh, absolutely. There are genuine geopolitical sensitivities woven into this stock that trigger violent short-term swings. But for patient capital looking to systematically capture the modernization of one of the world's largest economies, the foundation is solid.
The question is whether they can execute on that foundation.
That gives us the bigger picture. Now let's look at the fundamentals.
Because a great narrative falls apart the second the math stops working.
Very true. And the math here is revealing incredible top-line resilience. For FY26, revenue grew 10.7% to hit that 1.04 billion mark in constant currency.
Which is great, but top-line revenue is just vanity if you aren't keeping the money.
Exactly. And that's what stands out in the recent data. It's the massive margin expansion across every single vertical.
Let's hear the numbers.
Air ticketing margins are up 13.4%. Hotels and packages are up 15.7%.
Wow.
And bus ticketing jumped a staggering 29.3%. Plus, their ancillary revenue margin grew by 37.1%.
Okay, hold on. We need to unpack how a company suddenly increases bus ticketing margins by nearly 30% in a single year. You don't do that by just raising ticket prices.
No, you definitely don't. It comes down to digitizing a previously fragmented, totally offline network.
Right, because the bus system in India isn't dominated by a few massive corporate fleets.
Exactly. It's comprised of tens of thousands of independent regional operators. MakeMyTrip spent years building the software to aggregate all those independent routes onto one screen.
Ah, I see.
And now that the software is built and the network is established, adding the 10,000th bus operator costs them virtually nothing. That is pure operating leverage.
The fixed costs stay flat while the transaction volume scales.
Right. Every new ticket sold is significantly more profitable than the last one.
Operating leverage is great, but we also have to look at how they protect themselves when the environment turns hostile. Looking at the balance sheet, they are sitting on over $782 million in cash and cash equivalents.
They're a fortress. And operating cash flow grew 30.1% year over year to $156 million.
Yeah, and then we get to the debt, which is super interesting. It consists primarily of $230 million in convertible senior notes due in 2028. But the data shows these are at a 0% interest rate.
Yep, zero.
Wait, stop right there. We are living in a global environment where sovereign debt yields like 4 or 5%. Why would any institution lend a travel company nearly $250 million for absolutely zero yield?
Well, because they aren't looking for a yield. They were looking for equity upside. That is the magic of a convertible note.
Okay, walk me through that.
So the institutional lender gives the company cash up front without demanding interest payments. In exchange, the lender receives the option to convert that debt into actual shares of the company's stock later on at a predetermined price.
Ah, so they're essentially making a massive bet that the stock is going to explode in value.
Exactly. If it does, they convert the debt to equity and make a fortune. If it doesn't, they still just get their initial principal back in 2028.
And for MakeMyTrip, it means they get $250 million in capital flexibility without draining their monthly cash flow to pay interest.
Right. It's a phenomenal strategic advantage. It frees up cash to deepen their competitive moat.
And they already hold a 30.8% share of the domestic aviation market. But I'm noticing a heavy emphasis in the latest company reports on their AI integration.
Specifically, their AI travel assistant called Myra.
Right. Now, I am highly allergic to tech companies casually tossing the word AI into their earnings reports just to inflate their valuations. I mean, everyone claims to have an AI moat today.
Yeah.
What is this actually doing?
No, the skepticism is completely warranted. Most corporate AI is just a generic chatbot taped to a website.
Yeah, basically just an interactive FAQ page.
Exactly. But Myra is fundamentally different because it is deeply integrated into the actual booking architecture. Think of Myra like a highly advanced digital triage nurse.
Okay, how so?
When a customer has an issue, say a connecting flight is canceled or they desperately need to change the name on a hotel reservation, they don't want a list of frequently asked questions. They want it fixed.
They want action.
Myra autonomously handles 80,000 conversations a day, and it actually resolves 55% of post-booking queries without any human intervention.
Wait, really? 55%?
Yes, it actively reroutes flights, issues refunds, and updates itineraries instantly.
That is a massive payroll saver. I mean, a human customer service agent taking a 20-minute phone call costs real money. Myra handles it in seconds for fractions of a cent.
Exactly. And furthermore, users who interact with Myra on the front end show a 10% higher conversion rate compared to people just using traditional search filters.
So it creates a structural cost advantage.
Huge advantage. Smaller regional peers simply do not have the capital or the massive data pool required to train an equivalent system, making it nearly impossible for them to catch up.
That gives us the business picture. Now let's move to the catalyst timeline.
So looking at what could actually move the stock in the near future, the upcoming Q1 FY 2027 earnings report is the immediate hurdle.
What are the targets there?
Management has set the bar at 57 cents in projected earnings per share, with $313.09 million in revenue. That report will be the market's first test to see if they are regaining their footing after the recent EPS miss.
Routine earnings reports are one thing, but the data indicates there is a much larger structural shift brewing in the background.
Oh, definitely. There is explicit confirmation that MakeMyTrip is actively evaluating an IPO specifically for its Indian business.
That's huge.
It is. They have already completed the massive internal restructuring required to combine their key brands under a single Indian corporate entity.
Because currently they trade on U.S. markets, right?
Right, so a dual listing or a spinoff onto the Indian exchanges would unlock a completely new valuation paradigm.
It allows them to tap into a highly motivated pool of domestic capital.
Exactly. Local investors and funds who intimately understand the company's regional dominance and are willing to pay a premium for domestic growth stories that Wall Street might not fully appreciate.
But we had to put a giant warning label on this for the listener. I mean, IPO timelines are notoriously agonizing.
They really are.
They're entirely dependent on complex regulatory filings, bureaucratic approvals, and just shifting market conditions. This catalyst is absolutely not priced in yet.
And more importantly, no one should be trying to time this as a short-term trade trigger.
Right. Buying today with the expectation of an IPO announcement next month is a recipe for severe disappointment.
Yeah, viewing the India IPO as anything more than a speculative bonus for patient capital is dangerous. It is a massive potential unlock, but it requires enduring the waiting game.
Meanwhile, there are macro catalysts at play too.
Right, the more pressing macro catalyst is geopolitical. The ongoing West Asia conflict has created a severe bottleneck for their highly lucrative international travel segment.
So any de-escalation in that region would be massive.
It would immediately unblock those high-margin international flight routes and vacation packages. It would serve as a rapid upside re-rating event for their top and bottom lines. Catalysts tell us what could change the story. Now let's pivot to the chart.
So the price structure right now really reflects that psychological pullback we discussed at the top. The chart shows a pronounced gap-down phase directly following the Q4 earnings report.
Visualizing the immediate market disappointment, yeah.
Exactly.
Yet, while the headline price dropped, the volume and support metrics underneath tell a story of aggressive defense.
What kind of defense are we talking about?
Well, during that same Q4 period, management executed $50.3 million in share buybacks.
Wow. In one quarter.
Yes. To contextualize that, it is the highest in-market buyback execution they have deployed in a single year, all concentrated into one quarter.
Analyzing that institutional flow is crucial for understanding market mechanics. When a company executes an aggressive corporate buyback, right as retail panic creates a gap down, they're essentially vacuuming up the floating supply of shares.
Right.
They are telling the market, if you want to sell at this discount, we will happily buy it all.
Exactly. And historically, pairing a sharp gap down with massive internal buyback support establishes a physical floor under the stock. It often sets up what we call a higher-low structural foundation, which really highlights why visual perspective on these charts is so important. Traders navigating these gap downs often utilize tools to identify exactly where those support and resistance zones are forming, rather than just, trying to guess where the physical floor might be.
Which is where visualizing the data comes in handy.
Right, and this is exactly where an indicator suite like VIP Algos provides clarity, helping to visualize those structural foundations. But remember, charts only ever show probabilities based on historical data. They never provide guarantees of future price action.
So the chart gives us price structure. But what does market sentiment look like?
Well, the immediate mood is unquestionably tilted bearish. The market is currently hyper-focused on the fact that Q4 adjusted EPS came in at 32 cents.
Which narrowly missed the Wall Street estimate of 34 cents.
Right. It is always remarkable to see how a mere 2-cent miss against an arbitrary analyst projection can completely hijack a company's short-term narrative.
It's crazy.
It is a textbook example of market myopia. If you look past the retail reaction and examine the institutional and insider flow, the sentiment actually inverts.
How so?
Insider confidence is overwhelmingly positive, evidenced by that $50 million buyback we just discussed. Beyond that, major institutional players like Poland International Growth maintain their heavy holdings through Q1.
So smart money isn't running for the exits over 2 pennies.
Exactly. They recognize that the broader market is obsessing over a tiny earnings miss while completely ignoring the massive qualitative groundwork being laid from the real-world monetization of the Myra AI system to the structural reorganization for the India IPO.
That is a compelling bullish argument, but we have to ensure we stay grounded. I mean, is the institutional optimism entirely justified? Or are investors just getting distracted by shiny objects like the word AI and the promise of a future IPO?
That's a fair pushback.
Because it's very easy for a company to wave away a bad quarter by pointing to some magical future event. The reality remains that they missed expectations. In the current global economic environment, execution has to be flawless.
That sentiment picture is useful, but we still need to talk about the risks.
Yeah, the vulnerabilities here are substantial, particularly when we examine the macro environment. I mean, the West Asia conflict isn't just an abstract headline. It had a severe, measurable impact on their actual business operations.
It did. It essentially paralyzed a significant portion of their international travel demand.
Which dragged down their Q4 adjusted net profit by a massive 29.8%, down to $33.8 million. When outbound international travel stops, a highly lucrative revenue stream just dries up instantly.
Right, and that specific margin sensitivity is the core risk for this stock. Adding to the pressure, profitability also faced compression from significantly higher income tax expenses.
Not much higher.
They jumped to $6 million compared to just $1.7 million year over year.
Ouch.
Yeah. When you combine geopolitical margin compression with rising tax burdens, it inevitably attracts skepticism. Case in point, Morpheus Research announced a short position against the stock back in March.
Interesting.
If geopolitical tensions expand further, or if international travel remains depressed for an extended period, their path to expanding profitability becomes incredibly difficult.
Okay, let's play that out. If margins are already compressed and a coordinated short attack gains momentum, how does the company survive that pressure without the stock price entirely collapsing?
It all circles back to the balance sheet. That $782 million cash hoard is their ultimate defense mechanism.
Oh, right, because they have the capital to fight back.
Exactly. A cash pile of that magnitude, combined with management's proven willingness to aggressively buy back shares, acts as a formidable deterrent against short sellers.
A short seller knows that if they push the price down too aggressively, the company can simply buy up the float and squeeze them out.
Right. Furthermore, while their international segment took a hit, their operational agility allowed them to rapidly pivot and capture the exploding demand in domestic and spiritual tourism across India.
Which keeps the overall top line structurally sound.
Exactly. They are highly adaptable.
So everything on the table, what's the final verdict?
Evaluating the full scope of the research, we are issuing a bullish score of 8 out of 10.
Okay, an 8 out of 10.
Yes. The final stance is moderately bullish, but strictly viewed through a multi-year lens of 12 to 24 months. The strategic play here is waiting for that FY27 EPS inflection point to fully materialize.
All right, to summarize the thesis we built today, MakeMyTrip is the undisputed leader in a rapidly expanding market. They are successfully leveraging a legitimate AI-driven conversion moat to lower costs, and they are utilizing a massive cash fortress to defend their territory from market volatility.
Yep.
The primary upside driver over the next 2 years is capturing the surging demand from Tier 2 Indian cities, with a potential India IPO acting as a massive secondary catalyst.
And conversely, the primary risk remains prolonged geopolitical tension depressing those vital international travel margins.
Right. It is a powerful structural growth story, but it absolutely requires the discipline to ride out the inevitable geopolitical turbulence along the way.
Completely agree.
Before we wrap up, consider this shifting dynamic. For the entirety of the 2010s, the explosion of the Chinese outbound tourist basically redefined the global travel economy. Entire cities and industries adapted to capture that specific demographic.
Absolutely.
As India's middle class expands at an unprecedented rate, fueled by the infrastructure we discussed today, the Indian tourist is poised to become the next dominant force in global travel over the next decade. Platforms that control that outflow aren't just tech stocks. They become vital geopolitical assets, bridging domestic wealth with global markets.
It's a fascinating shift to watch.
Yeah, it really is. As always, we want to remind you that everything we discussed today is strictly for educational purposes. We are not providing financial advice, and you should never blindly follow a stock rating or score. Always do your own thorough research and carefully consider your personal risk tolerance before making any investment decisions.
Absolutely.
And if you want a cleaner way to read trading charts, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas.
It really helps cut through the noise.
It does. It can help make charts easier to scan, but it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.